Welcome to the Harvest Financial Advisors quarterly video update. I'm Marc Henn, President and Founder, and this update is for the quarter ending December 31st, 2023. In this video update, we will review what took place over the previous quarter in equity and fixed income markets, look ahead at the economy in 2024 and into 2025, give a peek into the return of that dreaded word, inflation, and wrap up with comments on expectations of market performance as we head into the new year. While my goal is not to use agricultural analogies for every newsletter, I have been asked by several people for an update on the ginger I had mentioned in the July newsletter. Ginger needs 8 to 10 months to fully grow, and after 5 months I had to dig it up because of a hard frost. I planted about 1 pound of ginger, and here's the result: 16 pounds of the best ginger I have ever tasted. The analogy? It is a reminder of the preparation that is so crucial for a great harvest. Sometimes multiple years of planning to create the right soil. And we take that approach in the work we do for you as well. While we do not discuss it frequently, we do a fair amount of forecasting and planning and employ multiple tools to assist us in this crucial investing step. You will hear some of these strategies as we get into our review. For reference, I'm recording this earlier than I usually do, about 2 weeks before the end of the quarter, and barring any unforeseen events, we should close out the year on a very positive note. One rule I learned early on in investing that has served me well is markets will do whatever they can to fool as many of the people as much of the time as possible. With this in mind, the fourth quarter did bring a surprise by showing up with a bad news is good and good news is great temperament. As an aside, please note that sometimes markets will trade opposite of this and see good news as bad and bad news as horrible. With the stock market slipping into this surprisingly positive trend, and coupling this with a recovering bond market as interest rates have fallen, the fourth quarter is providing a welcome finish to 2023. As quickly as interest rates jumped in the third quarter, they retreated substantially in the fourth quarter. The 10-year Treasury yield started the fourth quarter at 4.68%, went as high as 5%, and as of this writing has dropped back to 3.91%. To put this all together, the equity markets are rising and Treasury yields are falling with anticipation of the Federal Reserve not only being done with raising interest rates, but hope that the Fed will begin lowering rates in 2024. However, the Fed is stating that it plans to keep rates elevated for an, quote, extended period of time, unquote. Is this interest rate cut hopefulness well placed? Probably, as we expect the, quote, extended period of time, unquote, could be shorter than anticipated. I would like to provide some perspective on the interest rate increase over the past 2 years. Many of you can remember having a mortgage with an interest rate at or above 8%, and it felt normal. In this first chart, you can see the quick increase in the yield of 10-year Treasury notes over the past couple of years. Now, in addition, when we expand this view by multiple decades, you get a different viewpoint. We are working our way back to a more normal cycle as the artificially low rate environment we have been in for years came to a close. As we look into 2024, we do not see an exciting economic year, with the consumer being somewhat burdened and the financial industry being under pressure along with still tighter lending standards. This should put downward pressure on the economy. We believe the economy will show continued weakening in the first half of 2024, which will give the Fed the breathing room it needs to potentially begin reducing interest rates. Now, this in turn will lead to a lowering of short-term Treasury yields and the probable return of a normalized yield curve, one indicator that we are headed towards the bottom of this cycle. The possibility of a recession is still on the horizon, and if we have one, it should be mild. One note of caution: with 2024 being an election year, be prepared for a more negative news cycle than normal about the economy as it weakens. It will probably sound much worse than it is. Remember, markets typically look ahead to see what is coming, not what is currently present. 2025 looks to be a stronger economy, with us coming out of the bottoming process and back into an expansion phase. Another indicator that is showing this rebound is U.S. single-unit housing starts, which typically lead the economy by about 1 year. According to our friends at ITR Economics, this area shows signs of a recovery currently. In addition to this growth, we're seeing signs of the next wave of inflation. Yes, you heard it here first, with labor costs still being an issue as the labor shortage is predicted to continue into 2025, and what will most assuredly be the return of larger government deficit spending, along with renewed consumer spending, at this point we expect another rise in inflation in 2025. Looking ahead for equity markets, it would not surprise us to see an attractive single-digit gain next year amid additional volatility, again with the recent run-up we experienced at the end of this year. In fixed income markets, we see traditional bonds now rebounding with the quick drop in interest rates, while our protective positions continue to perform well this year. We should see a nice gain in our fixed income portfolios as the year comes to a close. In addition, traditional bond prices should rise as interest rates retract. In summary, we see equity and fixed income markets enjoying a rally with the expectation of stable and potentially falling interest rates. We look to 2024 to be a slowing economic year. However, we expect to see signs of a resurgent economy as we head into 2025. Traditional bonds should enjoy the environment of falling interest rates, and this can provide a lift to equities as well. Our equity and fixed income portfolios continue to perform well, along with income rising substantially over the past 2 years. As always, we will continue to take advantage of price fluctuations to add value to the portfolios. And if you have any questions, please let us know. And thank you for your trust.